everyone. Welcome to Morning Trade with Moneycontrol, your one-stop shop to get set for the trading day. I'm Karunya Rao. Let's get started with the global handover, which does continue to be weak. In fact, EU has been rattled. It's continued to be rattled by inflation worries. It was a day of carnage once again on European indices. Pan-European Stoxx 600 closed down 1.5% as all sectors and major bourses slid into the negative territory. Stocks and other risk assets have been pressured by inflation and the Fed Reserve's attempt to tamp down price increases through rate hikes, which have led to concerns about a potential recession. Wall Street saw another day of trade which was actually quite weak, with S&P almost close to entering a bear market. The index is almost 19% lower than its record highs this year. After a volatile week, stocks in Asia trade higher this morning, however. Investors will watch out for China's benchmark lending rate. If we look at SGX Nifty, it indicates to a positive start for the Indian market. However, domestic markets remained weak yesterday. If we look at the trading session, with Sensex shedding more than 1,400 points, Nifty was down 400 odd points in a single day amid broad-based selling. With more than 10% correction on the benchmarks year to date, is it a good time to invest? If yes, then how? How do you approach an immensely volatile market with looming macro headwinds? Aashish of WhiteOak AMC joins us to help us understand all of that and more. Aashish, thank you so much for joining us. I'm sure you're having many busy days right now with all of us, your clients, the various media, everybody asking one thing: how to navigate this uncertainty, how to manage the turbulence, because the retail investor is very confused. Just when everybody thought that the market is recovering, that we had formed a low, the market again corrected quite sharply yesterday. So can you put all of this in context for our viewers?
I think, Karunya, like you said, I heard you describing, so in the, say, from somewhere towards the fag end of 2021 and the onset of 2022, I think a series of events, which I would actually call more of them are imported problems really rather than domestic issues. Series of events, starting from China tech and then, that spread to US tech and then US raising interest rates. Even before the war started, actually, you saw that, oil commodity prices were high. But I think that, today, if you ask anybody, what is their view on the market? Generally, I think there is extreme amount of bearishness. That is one. And second is, if you were to check that, what leads to that bearishness, you will be recounted a series of reasons which by now are very well known in front of us. The other thing is that the market always reacts to surprises. If we go about recounting reasons like oil and commodity prices, or the war in Ukraine, or US raising rates, India raising rates, I think all of that is well known and factored in the market. I think it's just more like a regime change. We have seen in the US a long history of easing and very benign conditions for more than a decade. And now they have to do some kind of a reversal of course. I think it's only amidst the regime change or amidst that change of scenario is where you are experiencing this turbulence. But most of our problems, I would dare say, are imported problems in nature. The domestic conditions seem to be far better than what the market is reflecting. So I think it's transitory. Market is not very expensive, really, if you ask me. Market is not really expensive, if you ask me. And I think investors should be taking advantage of whatever turbulence we are witnessing right now.
But these imported problems, like you said, they're also hitting the market sentiment here, with FIIs continuing to, sell and not be very optimistic about emerging markets and investing overall, whether, across equity markets. But you're saying that this is a good time. A lot of stocks and sectors are available at attractive prices. So are you saying that the pain of inflation, rate hikes, recession worries, they've all been factored in and digested by the market?
See, I think that in between our market specifically read a lot into RBI's 40 basis point rate hike, correct? But you know what, two things to look at. To the extent that it was forced by supply side inflation, definitely I would agree that that is a bit of a setback. As long as we are seeing rate hikes because of demand side, look, rising rates and some kind of tension with relation to inflation is always par for course if you are witnessing an economic recovery or if you are witnessing a healthy expansion. Correct. So to that extent, I think we were on the right course. But then, yes, I do agree that supply side factors or US related concerns forcing us to tighten our monetary conditions. To that extent, yes, I agree that it's. But I think it's more again transitory and more like a temporary adjustment is how I would look at it. Also, during COVID, if we had taken extraordinary measures, I don't think one should see it very negatively if we are seeing some amount of normalization as far as monetary conditions and monetary policies are concerned. But if I go back to India's economic performance or our own corporate performance, I think that definitely suggests that we are witnessing better activity even compared to pre-COVID. If you see the reform momentum, if you see many other macro parameters which by now are very well known and discussed umpteen number of times, I think all of that really points out to positivity. You did mention in between about FPI flows. I don't know an accurate number, but from whatever I understand through my discussions, I don't think that those FPI flows are in any manner directly attributable to India's domestic conditions. Just look at it simplistically. $2 trillion is the size of global emerging markets as a category. And in that $2 trillion, on an average, 25 to 30% allocation is China. And if I'm not wrong, 7-8% is Russia. And in the last 6 months, 35 to 40% of any global emerging markets portfolio has been under duress. So if that were to actually see some kind of withdrawal, needless to say, India would be collateral damage because we are 15-20% of most global emerging markets portfolios. So I think we have to see what FPI outflows can be attributed to. And I don't think, well, yes, if commodity prices are high or oil prices are high, India does face some challenges. And in those circumstances, Brazil or Indonesia attracting some flows is par for course. But I don't think that those FPI outflows can in any manner be attributed to India's domestic conditions. In fact, if you ask me, 2010 to 2020, for the most part, when the US was booming, emerging markets hardly got any flows. So I'm saying that right now there is some kind of change of course or change of regime as far as global monetary policies and some equations are concerned. Not the best time to draw conclusions. I think, stay open-minded and see how it evolves in the next 3 to 6 months. But my sense is that we'll come out better.
Well, here's hoping that does happen. And of course, it will happen. There's nowhere else to go but up. But let's talk about some domestic trends as well that are playing out. If we focus on what's happening in the IT index, because that has caught a lot of attention. Yesterday, once again, it was down almost 6%. Overall, also, the IT index this year has been an underperformer. So overall, now that the correction has happened, do you think it's over, the pain is over, and perhaps this is a good time to buy the dip? Or do you want to wait it out and see how this plays out?
So, at WhiteOak, we are definitely not a sectoral investor. So we do have exposure across the board. I mean, IT has been a sector where in the last 5 years, consistently, we have made gains, and it has been a source of significant outperformance. Like you rightly said, 3 to 4 months of 2022 has not been that great. But I would say that is also got to do with the fact that PE multiples and valuations really shot up. Before COVID, IT was a hated sector. And post-COVID suddenly became a darling. So last 2 years has been fantastic. And, valuations kind of really got stretched. So now the thing is that while growth prospects probably remain intact, but still, what's your entry point and what valuations are we talking about? I think there is almost a 2x expansion in PE multiples in the last 2 years. That's generalization, but by and large. So we still have an overweight, but we have seen that, some profit taking has happened, some rebalancing of portfolios has happened, but we still continue to be overweight. And I would say that there is still significant potential to go ahead to the extent that some of the IT correction, again, is attributable to China tech and US tech. And, if you see some of our digital companies or some of our new age companies, see, broadly one looks at traditional IT, mid-cap IT or innovation, and then one looks at the digital or the tech. Now, my sense is that our digital or tech, not getting into company specifics, but our new age companies have got patched up purely based on sentiment coming from abroad, right? That is my sense actually. And I think all of them should not be painted in the same brush, because where India is in terms of its evolution versus where China was or where the West was are three very, very different things. Second is that while growth prospects continue to remain intact, I think in the last 3-4 months, we've obviously had some headwinds related to valuations. So we still continue to be overweight, and we still think it's a good place to be in. But yes, we ourselves have definitely reduced our overweights and made some rebalances in the portfolio.
But these new age tech companies that you're talking about, it's not just sentiment, but a lot of fundamental concerns have also been raised. Whether it's, I know you'd rather not take names, but whether it's Paytm, whether it's any other, recently listed new age startup companies that have raised a lot of money otherwise, but have failed to sort of reward its investors. And there are fundamental concerns related to the balance sheet, related to the profitability, operating metrics, etc. So do you think now that they have cooled off phenomenally from those highs, those listing gains that they yielded initially, do you think now perhaps retail investors can look at them actively and pick the good ones?
See, I think from an investor's perspective, if you were already an investor before this carnage, then definitely, it's not a great experience to have what has happened in the last 6 months. But that's a fact, right? Market always goes from exuberance to extreme pessimism. And from an investor's perspective, I think whatever has happened, it's good, right? Because till recently, the equations were all loaded in favor of people who were raising money and people who were entrepreneurs, founders, and promoters. And now if you see valuations, and you see some amount of early stress, with relation to funding and all those things, then I think slowly the equation is moving in favor of investors. So that's more a spectrum of valuation and spectrum of exuberance versus pessimism. But in that whole melee, can we paint the whole space with one white brush that, all of them have bad, all of them have performance challenges, all of them have governance challenges? No, that would not be true. It's just, I'm reasonably confident it's just going to throw up certain opportunities. And when those opportunities come up, I hope people are not wholly and grossly prejudiced, instead of really looking at picking opportunities. So suffice it to say that there are opportunities. And I would still repeat, I think a lot of the negative sentiment, if you recall, Karunya, it got built up after China started crashing, after US started crashing, and only then, so if, let us say, for example, if China didn't have those political pronouncements regarding their tech sector and the tech sector never started to collapse, then we would not be, it's possible that we would not be seeing things as negatively as we are seeing it right now. So I think you should watch out for the opportunities rather than painting the whole sector with one brush, because where we are in terms of our evolution, where we are as a tech ecosystem is very different from where some of the others are. Just for comparison, our political system is reasonably constructive on our digitization. We don't point out social problems just because some tech companies are expanding their presence.
Yeah. So you said it's a good opportunity for investors. So let's talk about those opportunities. Tell us, what are the pockets that look attractive to you right now?
I would say that, generally when you talk about these new age tech companies, I would just say that everything is being painted in the same brush. That's the limited point. But all of them, for instance, say consumer tech companies, I don't think all of them are in the, all of them don't have poor promoter holding. All of them don't have governance issues, right? So I think one just has to, and like we said that we have nearly 100 unicorns. Where are they all going? They are all going to coming in the, sorry.
I meant to ask the pockets in the market, not just within tech.
So I would say, sorry for that. I would just say that, say banks is one space, right? You might think that there's nothing insightful about what I'm saying, but I do feel that private sector banks are probably in the market, nothing ever comes as a no-brainer really, but it is closest to that is how I would put it. And the reason is because, pre-COVID, our system level credit growth was practically zero. And that may be one of the reasons why we didn't see so many accidents. And post-COVID, I think the performance has only been improving, right? So given that performance has been improving, and on the other hand, if you see the price movement is practically nothing in the last few months, that also could be a reason. That also could be because of what we have seen as far as FPIs are concerned. As you'll appreciate, in the index itself, banks and IT are between 35 to 40%. But in FPI portfolios, they could be larger because they are all, low promoter holding, very high free float, mostly large cap or mid cap-ish. So given that there is a very high preponderance of foreign flows with private sector banks, I think that could be a source of technical headwind really. But I think, there is a lot of potential. If the market were to get into any high beta trajectory, if the market were to witness any recovery, I think that is the space which stands to benefit significantly.
All right. Okay. So what has been your big learning from the current market uncertainty and turbulence? Because these are unprecedented times. We have a geopolitical crisis at hand, recession fears, inflation playing out. We just got out of a pandemic, almost have. So what should be investor strategy, the retail investor strategy amid a market like this? How should they go about investing or planning their investments?
See, I think my learning and what I would urge people to keep in mind, is that at times like this, there is an information availability bias. Look, as an investor or as a market observer, I have seen these like what I called a regime change or a global monetary policy change, right? That has happened in 2011, 12, and 13. That time also was marked by extreme turbulence, but ultimately it reverted back to what were the fundamentals of each of the markets, correct? Because these macros can create headwinds or tailwinds. They can certainly create some kind of benchmark for where valuation should be, because ultimately benchmarks valuations do depend on interest rates, no doubt about it. But that can only ultimately create some headwinds or tailwinds. When inflation is rising, interest rates are rising. Yes, PE multiples would compress a bit, but right now it is also accompanied by significant EPS growth. And I don't think domestic conditions have taken a turn for the worse. So these are a few things to keep in mind that, macros will create headwinds and tailwinds. But on the other hand, ultimately it will revert to domestic performance. The second thing I would say is that all the, compared to 10, 15 years back today, a massive amount of information is available to people. But I don't think all the information that is available to you is necessarily relevant. Just because you have information overload and just because you can see how many ships are stacking up outside Shanghai port or Los Angeles port doesn't mean all of that daily information is necessary for you to, factor into your investment thesis. For all you know, it may not be impacting where you are really investing. So I think there is a cognitive overload. Too much information. The world has been, or our markets or our investors have been through pretty much the same or similar set of situations multiple times over in the past also. And every time it has ultimately reverted back to corporate performance or domestic performance. So I think, focus on where you are investing in and focus on taking opportunities right now rather than getting caught up. And I think in India, we've seen 6-7% inflation. In my 22 years, I have seen 9% growth with 9% inflation, made a lot of people poor. I have seen 4% growth with 2% inflation, definitely didn't work for us. And I have also seen 8% growth with 6% inflation. So India, in our market, we've seen all, 7% inflation in India doesn't exactly mean what it means in US. So let's not get overly pessimistic.
Okay, Aashish, thank you so much for joining us and for sharing your learnings, your insight and your assessment of the market with our viewers. I hope they can gain from all that you had to share. Thank you so much, and we're bracing ourselves for a happy Friday. SGX Nifty is indicating to a gap up opening for the Indian markets as well, 220 points higher as we speak. Sneha Seth joins us right now from Angel One to talk technicals. Sneha, hi, good morning. We've got a lot of queries through the course of the show already. Just want to start right away with the first one on Infi versus Tech Mahindra versus Mindtree. Which IT stock do you like on the technicals? This is a question coming in from Ajay Dholani.
If we talk about IT space, we have seen recent correction, and if we want to choose one of the counter from all the three which you mentioned, I think HCL Tech would be the counter which I would prefer, because it is trading near one of the support zone. It has a support zone around say 975, 980 zone. So I think the risk reward ratio is quite good over here, and I think we can go ahead and long this counter with a stop loss of say 1080 will be the stop loss, and the target would be around say 1280. That should be the target.
Okay. Let's move on to the second question. Vedanta, for a 6 to 12 months time horizon, Kamalaja wants to invest here. Do you recommend buying Vedanta at the current level?
Yes, I would, because if you see, metals has corrected a lot. In fact, Vedanta, if you talk about Hindalco, I think these counters are really good, and the price wise also, I think the risk reward ratio is quite good. If you specifically talk about Vedanta, I think it has corrected a lot, and on the weekly chart, it is placed around at 89 AMA, which is acting as a support. I think keeping a stop loss of say 279, one can go long. We can expect it to go towards say immediately around 320 first, and then towards 335, 337.
Okay. Chandrakant Pante is asking about your target for RCF. The stock has done fairly well in the last 1 week. There's a lot of momentum seen there. Would you still bet on it?
Yes, of course, chemicals space has been doing good lately. So I believe this counter, if you see, there was a hurdle around 89, and this counter has surpassed that. If you see the chart overall, the volumes are quite decent. It has taken support near its 200-day simple moving average, and it has been showing decent strength. The volume is quite good. I think, yes, if anyone is holding it, I expect it to go higher towards 104 first, and then towards the recent highs of 112, 110, that zone.
Okay. We're a little pressed on time, Sneha, so we'll dive right into your stock picks for the day. I think you have a buy on Axis and Hindalco. Why don't you tell us what is the view?
See, at present, if you see, banking space has corrected a lot, and I think it has decent potential, especially the private sector banks. So I think ICICI, if for that matter, Axis, Kotak, everything looks good. But my preference would be Axis at this point in time. It has been taking support recently around say 640, 630 zone, and I think we can have a decent upside move from here on. So I think one can go long in this counter with a stop loss of say 630, and a target should be around 684. Apart from this, from metal space, we are liking Hindalco, as I already said. Hindalco has been taking a support. Like if you see the weekly chart, it has corrected towards the 89 EMA, and from there only we are seeing some respite happening. So I think we can go ahead and long this counter as well. The target for this counter will be around 454, and the stop loss should be around 398.
Okay, all right then. I'm really sorry, guys, we couldn't answer more queries today, but thank you so much, Sneha, for joining in and for sharing your technical assessment and analysis of the market and of various stocks that we wanted to address. Thank you, guys, so much. Let's see how the market opens. Looks like it's going to be a good day. Whether or not it can sustain that momentum is something to watch out for. It's time to wrap. I'll see you on Monday at 8:30 a.m. Right now, it's Santo and CJ coming up next.